You'll probably agree with me that stocks often rise and fall for no significant reason, which is a risk you can't avoid in the stock market. Sometimes I feel that daily stock movements are like April weather. After a long winter, suddenly the temperature shoots up to 20 degrees and the next day it snows. To survive as long-term investors in the stock market, you need to aim for the longest possible investment horizon. Investment risk in the stock market scares many a fund manager and it weighs on ordinary people like you and me. But how can you limit, control and manage risk in the financial markets as much as possible? Welcome to my Invest with Jiri channel. In today's video we'll look at the benefits of long-term investing, focusing on statistical data based investing over different time horizons and the results. We compare short-term intraday trading with long-term investing in the capital markets. How can you control the risk? I have mentioned in previous videos that one way to limit risk when investing, whether in stocks or ETF funds or other assets, is to use diversification. You buy assets from different sectors, i.e. finance, healthcare, consumer staples. That way you balance the sector risk of your portfolio. When technology sector stocks are not doing well, finance sector stocks are rising. Another way to limit investment risk is through asset allocation. Here you put some of your money in stocks, some in ETF funds, real estate, government or corporate bonds and so on. Geopolitical diversification still comes to mind. You invest part of your money in companies in America, part in Europe and part in Asian companies. As soon as there was unrest in the European area, you would have investments in other locations unaffected by the unrest. Although it is true that in today's globalized world, geopolitical diversification doesn't work very well. In today's video, however, I want to talk mostly about diversification based on long-time horizon investing, because I love investing in real estate and I manage a few properties. I never thought of fundamentally solving a downturn in the real estate market by selling my portfolio below cost, as is often the case with stock investors. I have a regular rental income from real estate and the fact that property prices fluctuate here and there does not raise my pulse at all. And like me, most real estate investors have it this way. But why is it different with investing in stocks? People are paralyzed when investing in stocks by the idea that the stock market could crash at any time. This prevents them from putting their long-term funds into one of the most profitable assets ever. Almost daily, we are presented with catastrophic news of stock crashes on television. These are such newsworthy topics that everyone comments on them, and of course people are interested. In any case, if you choose a long enough investment horizon, let's talk about 50 years or more, you won't even see any price fluctuations in the long run. It doesn't matter if the market fell 7% on Friday afternoon 10 years ago or rose 10% 15 years ago. The long-term curve of our investment will smooth out so much that daily movements cease to interest us. If you are going to hold your investment for 20 or 30 years, it's pointless to track it on the chart every day. There are much more fun things. Why do I think you should avoid short-term trades? By short-term trading, I mean holding a stock for a few days, hours or just a few minutes. Here you have a high risk of losing the money you invest and you can often make mistakes when entering trades. I would say it's more of an adrenaline rush than a serious approach to trading capital. Such a casino gambling. Short-term traders find a strategy they like on the internet and start trading in without the necessary testing. Then they wonder why their account is getting thinner and the miracle strategy doesn't work. There are also more responsible individuals who develop their own strategies and these can be in profit for months or years. However, it is a mistake to assume that they will beat the market in the long run. The volatility of moods associated with fear and greed is one of the foundations of financial markets. Therefore, in the long run, it is difficult to find a strategy that will repeatedly win in the markets. I myself have tried 10 years of intraday trading of my own strategies and also automatically generated strategies on 15 to 20 years of minute or thick historical data. I can responsibly tell you that you don't stand a chance against the market over the long term. You will make some nice money here and there, but you have to realize that you are facing an army of computers that use automated trading systems. You are fighting hedge funds with unlimited funds. They can develop strategies with teams of the smartest mathematicians in the world. What chance do you have against them? You can't win. It's sad, but it's a game of statistics where you roll once and your opponent rolls 10 times. I leave the fight against the machines to Arnold Schwarzenegger. Let's go back to long-term investing and its main advantages. Number 1. Less time consuming. If you don't invest for a year, nothing will happen. The money is still working. Number 2. You pay less for buying and selling with a broker. Compare the fees of a person who makes 1 trade a month with a person who makes 10 trades a day. Number 3. You use compound interest. In the long run, this in particular works wonders. Interest on interest. Great stuff. What are the statistical results of investing for 1, 5, 10 or 20 years? Now let's look at different investment horizons and the effect on the ups or downs of different periods in the financial markets in examples. According to Nobel Prize winner Robert Schiller, the return of the US market over the last 152 years measured on the S&P 500 is 4.4% without dividends, 9% with dividend reinvestment and 6.9% with dividend reinvestment and accounting for inflation. What is your probability of capital appreciation or capital loss over 1, 5, 10 or 20 years? If you look at the following figure, you can see the real return including dividend reinvestment and accounting for inflation. With a 1-year investment horizon, you can achieve an appreciation of up to 53.2% or a loss of 37%, an average of 8.4% per year. If you increase the investment horizon to 5 years, you have a probability of a gain of 28.5% or a loss of only 11.7%. On average, that's 7.2% per year. If you invest for 10 years, you have a maximum appreciation of 7.6% or an even smaller loss, 4.1%. The annual average comes out to 6.9%. And the best part at the end, if you invest for 20 years, you can appreciate your capital by 13.2% maximum and lose 0.5%. On an annual average over 20 years, we are talking about an appreciation of 6.6%, all with reinvestment of dividends and accounting for inflation. I think this is evidence enough to focus on long-term investing without having to watch the fluctuations in the financial markets on a daily basis. As a long-term investor, you are several times more likely to survive in the stock markets, preserve your capital and also appreciate in value. I'm so glad you watched the video to the end. If you would like to learn more about investing in stock analysis companies or calculators for calculating adequate stock price, please join my Patreon, link in description. If you enjoyed the video, please give it a like. I look forward to seeing you next time and invest wisely and for the long term.